Welcome to this explainer. Okay, let's dive right into this. We hear about fintech literally all the time, right? Digital payments, mobile banking, algorithmic lending. But usually we only talk about it in terms of how it makes our daily lives just a little bit more convenient, or maybe how it helps a specific bank boost its own bottom line. But what if I told you that completely under the surface, fintech is secretly rewiring entire macroeconomies? Today, we are going to explore some absolutely fascinating, non-linear ways that financial technology is acting as a massive catalyst for macro-level productivity shifts.
So, here is our roadmap for how we're going to unpack this today. First, the productivity puzzle. Second, the regional catch-up. Third, the regulatory Goldilocks zone. And finally, rewiring industrial structures. Let's jump in. All right, Section 1, the productivity puzzle and how we are defining a totally new economic era. For decades, we've basically thought of productivity as just doing things faster, like speeding up a manufacturing assembly line. But to actually grasp fintech's true impact today, we really have to look at a totally new framework. It's called New Quality Productive Forces, or NQPF. This isn't just about basic input-output efficiency anymore. It's about fundamentally changing the nature of our labor, the tools we use, and our materials. So NQPF breaks down into four really clear dimensions. First up, you have the new labor force, which is all about knowledge-intensive human capital. Then new labor objects, think sustainable and digital industries here. Next is new labor materials, relying on modernized infrastructure like 5G networks and green energy. And finally, permeating factors like institutional support and R&D. Now, why does this matter? Well, fintech acts as the ultimate catalyst across every single one of these dimensions. It funds the education, it efficiently allocates capital to those digital industries, it builds out the infrastructure, and it backs the R&D. It's the engine for the whole shebang.
And here is the crucial data point that proves it. Drawing on a massive, decade-long panel data study of Chinese provinces, researchers found something wild. A 1% increase in fintech development yields a direct 0.044% surge in macro-level NQPF productivity. I mean, that is huge. It proves that the micro-level efficiency we see when we open a fintech app on our phones is actively bleeding into massive macro-level economic growth.
Moving on to Section 2, the regional catch-up. This is basically the underdog advantage.
So this productivity surge, it is not happening equally everywhere. When researchers looked at the spatial distribution across China, they found a really stark contrast. The established eastern region, places like Guangdong, they already have the highest baseline productivity scores. Guangdong actually tops the chart at 0.608. Now, the developing western region obviously starts with a much lower baseline. But here is the kicker. The marginal growth rate in the west is actually higher. Look at the fintech impact coefficient. In the east, it's 0.036, but in the west, it is a staggering 0.131.
Basically, fintech acts as a great equalizer. If you are an already established, highly optimized region in the east, sure, fintech gives you a nice little bump. But if you are a developing region in the west and you're playing catch-up, fintech offers a massive marginal boost. It completely bridges the gaps in traditional financial infrastructure, which literally allows underdeveloped regions to leapfrog straight into high-quality productivity. It's a total game changer for them. That brings us to Section 3, the regulatory Goldilocks zone. We need to find that sweet spot.
Now, obviously, all this rapid growth doesn't just happen in a vacuum. It requires the ultimate tightrope walk from policymakers. So I want to ask you, how much financial regulation is too much for fintech innovation? Because you absolutely need enough rules to prevent systemic risks and crashes, right? But if you regulate too heavily, you just crush the exact innovation that's driving all this productivity. So where is the line?
Well, according to the hard data, the line is exactly 0.0021. This is a very specific regulatory intensity threshold. It's measured as the ratio of government expenditure on financial regulation to the value added by the financial industry. And the researchers discovered that the absolute moment an economy crosses this exact number, the rules of the game suddenly flip for fintech companies.
Think of it exactly like the Goldilocks zone. If regulatory intensity is too far below that 0.0021 mark, the environment is just too cold, too relaxed. You end up with fragmented rules across different regions. That creates technological path dependence, meaning companies build these isolated, siloed systems that can't scale together, and that totally limits the network benefits. But if regulatory intensity pushes above that number, it gets way too hot. The positive impact of fintech sharply drops off because suddenly companies are diverting their resources away from cool new R&D and pouring it all directly into really expensive compliance. It completely stifles innovation. The sweet spot is right at that threshold, where regulation acts as a standardized guardrail, not a cage.
And I want to be clear, this isn't just some abstract theory. Using really rigorous threshold regression models and bootstrap resampling, the empirical data from the study definitively proves this nonlinear relationship. Simply throwing more financial regulation at the wall does not automatically make fintech safer or stronger for the economy. It actually requires a highly calibrated approach that's tailored to local conditions.
All right, our final section, number 4, rewiring industrial structures, the actual engine of change. So we know fintech boosts macro productivity. We know it helps developing regions catch up, and we know it requires a super delicate regulatory balance. But what is the actual on-the-ground mechanism driving these shifts? Well, it comes down to this brilliant quote from the study. Fintech acts as an important catalyst of creative destruction by accelerating the reallocation of capital and information. Now, creative destruction is just this idea that old, inefficient economic systems and industries basically have to be dismantled to make room for new, optimized ones. Fintech is the literal engine accelerating that exact process. Let's break down how this builds step by step. First, fintech introduces digital tools and AI risk management that dramatically lower financing and transaction costs. It's just cheaper to do business. Second, because capital can now move so much faster and cheaper, resources rapidly shift away from those outdated, clunky industries and flow directly into emerging tech and green sectors. Third, this causes the entire industrial structure of a region to be rationalized and optimized. Essentially, the whole economy just becomes leaner and a whole lot smarter. And finally, step 4, this structural optimization leads to that massive surge in macro-level new quality productive forces we talked about earlier.
So the big takeaway here? Fintech is far more than just a convenient app for splitting a dinner bill. It is a macroeconomic engine. It reshapes labor, it totally levels the playing field for developing regions, and it forces entire old-school industries to evolve. But as we've seen, its success is incredibly fragile. If its true power relies on walking a highly specific regulatory tightrope, you really have to ask yourself, is your region building the guardrails needed to guide innovation forward, or are they accidentally building cages that are going to trap their own economic growth? Keep thinking on that one, and I'll catch you next time.